In this week's video, we'll review the latest charts and data to help us answer the question, is it time to dump stocks? We'll be moving quickly, so feel free to use the pause button on your video player. 100% of this week's video is being recorded after the close on Friday, September 6th. On September 6th, NFP, or the monthly labor report, was released at 8:30 a.m. Eastern Time, right side of your screen. Ed Yardeni commenting on the report. We don't see a recession in today's report. Instead, we think it supports our productivity-led Roaring 2020s outlook. Finally, we still think stock prices will remain choppy through the November 5 elections before resuming their climb to new record highs. All of that is very similar to the bullet points from last week's video. Volatility may continue. There's a lot going on in the coming weeks, but the bias should be to the upside over the next 6 months. 6 months is significantly different from 4 trading sessions. So as we go through the charts from Friday, September 6th, we want to ask and answer, does the data in front of us support or contradict all of this? Let's take a moment to review this financial crisis chart of RSP, the equal weight S&P 500. Then we're going to use the concepts to see what we can learn about September of 2024. The S&P 500 peaks here in October of 2007. This is a deflationary bear market, and you can see the trend in RSP clearly rolls over and has a very concerning look early in 2008. This is January. Now, we just said this is a deflationary bear market. 2022 produced an inflationary bear market, meaning the combination of the fundamentals on the left side of the screen significantly different relative to the combination of the fundamentals that caused the downturn in 2022. And yet, the rollover look in the trend looks almost identical. A trend is a trend is a trend. This is one of the reasons why the charts are so valuable. And you often hear this, charts and moving averages only tell us what has happened. That's true. That's true of every single economic data point. No one has charts or economic data points in the future. It's not about predicting, it's about assessing probabilities based on the data in front of you. I can assure you it was extremely helpful to know in January of 2008 that the chart of RSP looked this vulnerable and significantly different in January relative to January of 2007. So let's change the chart on the right side of the screen and see how that rollover look, the inflationary bear market in 2022, compares to the present day. You can see the right side of the screen on September 6th really doesn't look anything like this over here in October of 2007. The right side of the screen here on September 6th really doesn't look anything like Q1 of 2022. In fact, early in the session on September 6th, RSP still had a full-bore bullish look, with blue the fastest moving average on top, black the slowest moving average on the bottom. The slopes of all the moving averages are up and prices above all of them. Doesn't look anything like this. Doesn't look anything like this. Is it possible it's going to morph into something like this? Sure, it's possible. But now you're asking us to predict. We could have said the same thing here. The market's about to peak. The market's about to peak. The market's about to peak. We're about to go into a recession. The monthly NFP report is about to turn negative. You could have said that every single month for the past 2 years, and it would not have been helpful. But over the past 2 years, if you said, let's not get too concerned until we see the monthly labor report flip into negative territory, that's been incredibly helpful. This is the look we want to avoid over here on the right side of your screen, January of 2008. This is the look we want to avoid here in Q1 of 2022. And this is the same chart of RSP with the same moving averages at 10:54 a.m. Eastern Time on Friday, September 6th, after NFP was released. Shorter-term concerns would increase if we drop out of a consolidation box, as we did here, 2007. Right now, this box that dates back a few months serves as an area of potential support until proven otherwise. And if we step out, this still looks like healthy consolidation in the blue box, holding the bullish breakout from the multi-month, multi-year green consolidation box. This looks like a bullish breakout above this level here in early 2022, late 2021. Healthy consolidation above the box and then a bullish breakout. And you could say possibly we need to retest this area. It's also noteworthy that the top of the green box, if we came back there, intersects with an upward sloping 250-day moving average in black. Moral of the story, this is unequivocally still a chart in an uptrend. Remember in last week's video, we said VEA was one of our weaker positions. You can see on a relative basis, chart from last week, VEA is in a downtrend relative to SPY. But we also said if we looked at VEA in isolation, like RSP, it looks strong. This looks like healthy consolidation here above this breakout level from 2021. And we also said it's difficult to say that European stocks ending August at a record high. It's difficult to say that's bearish. The takeaway here is foreign developed markets, a broad ETF, had a very constructive look at the end of August. And Sentiment Trader, you can go to sentimenttrader.com. Here's the website, picked up on the same basic theme this week. An exceptionally strong time for developed markets. All major markets are in medium and long-term uptrends. That's very, very rare. In fact, it only happens about 5% of the time. And when it happens, the annualized return in the S&P 500 is a hair over 20%. Significantly higher than all other days, with the annualized return below 7.5%. And if we look at the signal dates in detail from Sentiment Trader, when something like this is happening, and it's happening in the present day, in the past when you walked forward, 3 months later, the S&P 500 was higher in every single case, average return 5.9%. 12 months later, the S&P 500 was higher in every single historical case, average gain 14.3%. Also noteworthy, none of the signals occurred near the peaking process before the market fell in the 1973-74 bear market. None of them occurred during that bear market. No signals here before the S&P 500 peaked in 1998 into the spring of 2000. No signals in the entire bear market, and the same thing can be said in the lead up to the peak in October of 2007 that we just covered on the chart of RSP, and we got absolutely zero signals during the financial crisis bear market, zero signals during the dot-com bust bear market, and zero signals during the 1973-74 bear market. Thus, something that just happened contradicts the thesis that the S&P 500 is making a major peak similar to early 1973, late 2000, and or October of 2007. Let's assume for a moment that you do not like moving averages, and let's assume that maybe you don't like anchored volume-weighted average price charts either. There's really no debate here that the last thing RSP did was make a new high. It hasn't made any significant new low recently, and all of this is occurring above an upward sloping 250-day moving average. Of course, all of that is subject to change, and possibly rather rapid change. In fact, today would have been a good day for something like this to happen. It really didn't happen. RSP was down today, but it finished well above the August 5th low. Since we're using a weight of the evidence approach, let's look at an anchored volume weighted average price chart. This purple line here and this orange line here. That line tells you the average cost basis weighted by volume. Why is weighted by volume relevant? It means institutional money is more significant relative to somebody trading their account at Fidelity or Schwab. And that makes sense because institutions are more powerful in terms of their potential to move markets. These two lines basically tell you when price is above these lines, anyone, on average, weighted by volume, that entered the market at either the COVID high or the COVID low was profitable. Here, on average, weighted by volume, they were at a slight loss. You can see the equal weight S&P 500 made a stand near those lines at the October 2023 low, establishing this as a reference point. And thus far, there's nothing on this screen that tells us institutions have changed their mind about buying in here. Every time prices come back near these lines, institutions have defended it here, 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 and on August 5th. Thus, right now, the look of this chart continues to say the uptrend off the October 2023 low is still in place, and we should try to be patient and think longer term. In markets and in life, there has to be a bigger yes. What do I mean by that? If you're fearful during Friday's session and you want to sell because you think it'll make you feel better, you have to ask yourself, what's more important? Feeling good intraday on September 6th or feeling good at the end of the year? And is feeling good intraday on September 6th more important than potentially holding positions within the context of a secular bull market for another 2, 3, 4, possibly 5 to 10 years? Moral story here, there's really nothing on this chart that gives us a logical reason to be doing anything on September 6th except holding and seeing how it plays out day by day with an open mind about a wide range of outcomes. Since we're using a weight of the evidence approach, do the other charts line up with all of that, or do they contradict it? So again, we have a base stacked on a bigger base. Concerns would increase if price moved all the way into this area and really below this blue line here tied to the July 2023 high. That absolutely may happen with all of the uncertainty that we have. And if it does happen, we'll have to evaluate the weight of the evidence at that time. Similar situation with tech during the session on September 6th. There's a reason why we put this on Twitter before the NFP report. It says the S&P 500 closed at 5186 on Monday, August 5th. Thus, the S&P would have to drop over 317 points after NFP to exceed the recent growth scare low. Why is that relevant? If market participants were really scared about growth, logic tells us that we would be exceeding this intraday low here after the NFP report. That may happen soon, but right now this looks like a higher low relative to this growth scare low from August 5th. And all of this is happening above both of these anchored volume weighted average price lines. Price respected the top line here, here, and the bottom line here. Bearish concerns would increase if we move into this area here, respecting that short-term overshoots are common. The longer below the red line, the more relevant it would become. Right now, this is telling us that XLK's trend off of the October 2023 low is still in place. Same concept here. This chart over here on the left, the smaller box, is the S&P 500 when it was down 91 points during the session on Friday, September 6th. You can see when we were down 91 points, the S&P was trading at 54.12. That's almost 300 points higher than the intraday low on August 5th. This is an area of potential support. This is an area of potential support near 5,300. And this area in here at 5376 is an area of potential support. Not making any assumptions that any of that will hold. But right now, this looks like a higher growth scare low until proven otherwise. There's also a reason why before NFP at 7 p.m. Eastern Time on Thursday, September 5th, that we put this reference point tweet out there. These numbers aren't particularly relevant because we know they're going to change. What is relevant is how they change after the labor report. So if market participants believed that the labor report on Friday, September 6th was horrible and a recession was right around the corner, we would expect the probability of a 25 basis point cut to drop and the probability of a 50, the larger cut, a 50 basis point cut to rise significantly. Is that what happened? Did this number drop and did this number go up? Not during the session on Friday, September 6th. It was just the opposite. Market participants during the session placed a much higher probability on the small cut and a lower probability on the bigger cut. Meaning, changes in the bond market on Friday, September 6th align with all of these higher lows that we have thus far. Again, not making any assumption about whether or not these August 5th lows are going to hold or these lines are going to hold. But the chart in front of us right now, they're holding. See how it plays out. Very similar situation with SMH, semiconductors. Intraday on Friday, well above the intraday low on August 5th. And yes, we can see this, and this. All that becomes meaningful if you break this low here or the neckline. The longer below the August 5th low, if we get there, the more relevant it would become. And notice, just below the August 5th low, the intraday low, is this orange line and this purple line. Tied to this gap up area here, important region in 2023, and tied to this high here in July of 2023. Again, based on the look of this chart, there's nothing here that says the trend off of the October 2023 low has changed yet. On the ropes? Yes. Should we pay closer attention? Yes. And we should also understand that markets like to overshoot. So if we move into this region here, the longer we stay below these lines, the more relevant it becomes. Very similar concepts with SPY. Remember, this tells us a lot about cost basis. 2022 peak, October 2022 low. Look where they intersect. Right where institutions stepped in October of 2023 and decided to buy again. A lot of these lines in here are tied to gaps. And relative to this low here, and relative to this low here, and this high here, we have nothing on the chart of SPY during the session on September 6th that says anything other than uptrend. Prices above anchored volume weighted average price lines that are rising. So even if we undercut the August 5th intraday low, there's still a lot of reference points in this band here. Day by day with an open mind about a wide range of outcomes. How about leadership? Very similar situation with the tech sector relative to the equal weight S&P 500. There's nothing here that says the outperformance trend in tech from the 2023 low in January of 2023, that trend has ended. Again, on the ropes, it is. But thus far, this is a higher low relative to this intraday low, and even if we undercut this, we've got some good reference points in here. Has tech-heavy SPY given up its leadership trend relative to the equal weight S&P 500 RSP? It has not. Ratio's well above the line tied to the 2023 low. It's also above the lines tied to the late 2023 high and this low here early in 2024. Again, vulnerable on the ropes? Yes, on both counts. But if we can't be patient when the ratio comes back near the points of reference, then the points of reference, for the most part, are useless. And if this gives away, which it absolutely may, then this becomes our next major point of reference. Also noteworthy, all of this in these lines here, this is occurring after a bullish breakout from an extremely long-term consolidation box period of indecision. This is 2020 back here. This is 2023. We break out here in 2024. And thus far, this looks like a breakout in here and somewhat of a retest look happening above these important or relatively important reference point lines that may act as support, possible support. The market's going to decide whether they hold or whether they give way. Thus far, they're holding. Very similar concepts here, as the tech sector, the large cap tech sector, clearly given up its outperformance trend relative to IWM or small caps. It has not. Important gap up here. The ratio makes a stand here, makes a stand here, here, near these levels here, and we're at that region again. So we'll learn something about leadership if this ratio moves into this area here. The longer it stays there, the more relevant it will become. And we would also know that we have these lines down here as potentially your next point of reference. This is the same anchored volume weighted average price chart that we've shown in the past. It helped us on August 5th. These lines here tied to this high and this low. Thus far, or at least intraday, we were holding above those lines. But for the S&P 500, for us to get a little more concerned, we'd have to undercut that August 5th growth scare low. And if that were to happen, then this would become another point of reference. It's hard to make the argument that this move from here to here is really much different than all of the consolidation that's happened in the S&P 500 in this region here. All of it has occurred above these rising anchored volume weighted average price lines, indicating an existing and still in place uptrend until proven otherwise. Trade the chart in front of you. Just as this chart dated September 6 helps us monitor the existing trend in XLK relative to the October 2023 low. Right, this chart looks pretty busy, but it's easy to understand. It's fairly obvious this region in here, based on the ratio of the NASDAQ to the S&P 500, is important. Price has been bouncing around this area for a long time. This is 2023 in here. This is September 6th over here. Remember, these are anchored volume weighted average price lines. So this tells you cost basis weighted by volume going back to this 2018 high and this 2018 low. You can see that area was relevant in here, and when the lines came together, that's when price or the ratio really started to take off. And you can see they were relevant again in here as the market stalled for quite a while before it took a big leg down, or at least the ratio took a big leg down in 2022. And you can see those same lines have been relevant walking forward from 2023 to the present day. And now we have an intersecting line with the anchored volume weighted average price line tied to the late 2022 low. So when these lines intersect, it's telling us this is an important region. And thus far, the bullish breakout in the NASDAQ relative to the S&P 500 is still in place as long as the ratio stays above these three lines. We know it can overshoot. The longer it moves into this area here, the more concerning it would become relative to the leadership by the broad NASDAQ composite relative to the S&P 500. In simple terms, walking forward from this point, when the ratio is above the two lines, we're in risk on. When you're below the two lines, you're in risk off. It's telling you the odds have favored risk on for quite some time, but it's still highly indecisive. We'll see how it plays out. This is 3:41 p.m. Eastern Time, about 19 minutes before the market closed following NFP on Friday, September 6th. If you've been in the markets a long time, and this is not a prediction in any shape, form, or fashion, it is an anecdotal observation / opinion. When you see headlines like this, S&P 500 tumbles Friday to post worst week since 2023. NASDAQ drops 2% for worst week since 2022. Again, not a prediction here, but given the fact that we made a stand above this area that's been relevant in the past, tied to the October 2023 23 low, and this is the chart of XLK, the S&P 500 technology sector ETF, it wouldn't be shocking if next week's headline said almost the polar opposite. S&P posts best week since. NASDAQ posts best week since. Again, not a prediction, but given the chart in front of us and this higher low, it's definitely within the realm of possibility. As we head into next week, it's also good to note about these gaps. They also serve as potential reference points. The S&P 500 closed on Friday at 5408. So right in this region here. So if we opened weak on Monday, this gap here around 5350 would be potentially relevant, but that's just one of many reference points. The look of this chart is not screaming imminent bear market, nor this chart. And secular volatility scores during the session on September 6th also align with the concept of trying to be prudently patient in the days and weeks ahead. And the fact that all major markets are in medium and long-term uptrends. And when something similar has happened in the past, something that's very rare, the annualized return for the market is over 20%. And in these historical cases, we're looking at every single case in this window, back to 1975, the S&P 500 was higher in every single case, roughly 6% 3 months later. Average gains 6 months later, 10.2, with 91% of the cases higher. And batting 1,000 looking out 12 months with an average gain of over 14%. Simply telling us to keep an open mind about better than expected outcomes. If the charts in front of us start to violate some of these important levels, and the economic data starts to look more recessionary, then concerns would increase. This is one experienced voice. Ned Davis Research is another. The gist of all this is 10 indicators that have a good track record of predicting recessions. How many of them are flashing recession? Only 2 out of 10. This aligns with this, and all of this, and all of this. And as we've just covered with September 6 charts, all of this still applies until proven otherwise. None of this is particularly useful unless we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.